Stop what you were doing. We just saw one of the strangest financial weeks in recent memory. Washington was in complete chaos. The U.S. government officially shut down because politicians couldn't agree on a budget. Now, normally, a government shutdown is the kind of massive uncertainty that sends markets running for the exits, slamming the sell button. But not this time. This time, the market didn't panic. It did the exact opposite. It rallied to historic highs. We're talking about a week where bad news was the best news you could possibly get. This entire rally was driven by one single assumption. The chaos in D.C., combined with the resulting lack of economic data, painted the Federal Reserve into a corner. Investors are betting big that the Fed now has no choice but to start cutting interest rates even faster than planned. That's right, Wall Street looked at a failed government and said, "Thank you, sir. May I have another record high?" It was a calculated gamble based on the belief that any political paralysis would be short-lived, but the Fed's willingness to prop up the economy is permanent. This theme dominated everything, and it turned October into an explosive month for risk assets, especially the one that really stole the show. Let's talk stocks first. The major indices finished the week strong. The S&P 500 gained about 1.5% for the week. The Dow Jones Industrial Average led the pack, getting almost 2%. Both indexes closed the week at brand-new record highs. But Friday, specifically, showed some cracks. While the Dow finished its monster week up almost 80 points, the tech-heavy Nasdaq composite took a breather. It actually dropped almost 70 points on Friday. Why the split? Investors were rotating their money. They took some profits off the table from high-flying tech giants and dumped that cash into sectors that are expected to benefit most when the Fed starts slashing rates. We saw money flowing into cyclical sectors like industrials and financials. This is a classic play. If interest rates are going down, boring companies look better because their cost of borrowing goes down. We saw some wild moves in specific stocks too. Palantir Technologies, a major tech name, had a brutal Friday. Its stock absolutely tanked, dropping 7.5%. This huge sell-off came after news that the U.S. Army issued a warning about security issues in one of Palantir's systems. That put a huge drag on the whole tech sector. Meanwhile, the semiconductor space was confusing. Demand for artificial intelligence infrastructure is still huge, so companies like Micron and TSMC climbed higher. But the massive chip leaders like NVIDIA and Intel ended the day slightly down. It was a messy finish, but overall, stocks were clearly signaling huge optimism about the future of cheap money. The missing piece of the puzzle this week was official economic data. Because of the government shutdown, critical reports were delayed. The biggest one? The non-farm payrolls report, which tells us exactly how strong the job market is. Without that report, the market essentially flew blind. It created a serious data black hole. And in the absence of hard facts about the economy's health, speculation went through the roof. The few reports we did get were completely contradictory. A survey of the services sector, the ISM Services PMI, actually dipped right down to 50. That 50 mark signals a serious slowdown in the service industry. That's worrying. But then another major survey, the S&P Global Services PMI, came in strong at 54. So, is the economy slowing, or is it strong? Nobody knows for sure, but the market has decided that the uncertainty and the lack of jobs data just make it easier for the Fed to pull the trigger on rate cuts. And speaking of the Fed, their statements this week were interpreted as a green light for lower rates. A top Fed official stated that the gap in data flow makes their approach to risk management even more critical. Wall Street immediately translated that as, if we don't know exactly how healthy the patient is, we'll give them the medicine anyway. The bond market confirms this belief. Treasury yields spent the week pricing in lower rates. The yield on the 10-year Treasury note settled at about 4.1%. More importantly, the bond market is now locking in the expectation of an interest rate cut. Right now, the odds for a rate cut at the upcoming October meeting are sitting at over 95%. The government shutdown didn't just push up the odds for an October cut, it also put a second cut in December firmly on the table. But the biggest winner, the undisputed champion of this strange week, was the crypto market. It absolutely smashed it. The October rally narrative became very real. Bitcoin was the best performing asset of the week, surging over 15%. Bitcoin blew past the massive $120,000 psychological barrier, and by Friday's close, it was consolidating up near $123,000. Ethereum followed suit, gaining ground and trading close to $4,500. Why did crypto go vertical while DC melted down? Two major reasons. First, the safe haven narrative roared back to life. When the US government looks dysfunctional, investors start looking for alternatives. Bitcoin's decentralized nature, meaning no government can shut it down or mess with it, suddenly looks extremely attractive as a store of value. It's the ultimate protest asset. Second, the US dollar took a beating. Because rate cuts are expected soon, the dollar weakened significantly against other global currencies. The dollar index, which measures the dollar against a basket of currencies, broke a critical support level and finished the week near 98. When the dollar weakens, assets priced in dollars, like Bitcoin, become instantly more appealing and cheaper for international buyers. This fueled the pump. Institutional support helped too. Huge banks like JP Morgan released positive analyses on Bitcoin, adding fuel to the confidence fire. The safe haven theme wasn't limited to crypto. Gold also had a strong week, gaining over 2% and settling around $3,900 an ounce. Gold benefited from the double whammy of political uncertainty driving safety demand and the expectation of lower interest rates, which makes non-yielding assets like gold more appealing. Meanwhile, oil prices were flat, sitting right around $61 a barrel. Even though OPEC is cutting production to keep prices high, fears of a global economic slowdown, the same slowdown signaled by that confusing services data, kept gains in check. Looking ahead, everything hinges on two things. First, we need to know what's happening in Washington. Are they going to open the government back up? Any sign of a deal could keep the rally going, but if the shutdown drags on, expect volatility to spike. Second, the focus is squarely back on inflation. Since the jobs data was canceled, the market's next major guide will be the inflation reports, specifically the producer price index and the consumer price index. These numbers will be the final word on what the Fed decides to do next. If inflation is sticky, it could crush the rate cut expectation that is currently powering this whole market. Keep a close eye on tech stocks, too. After their incredible run, we might see more profit-taking as investors continue to rotate into those cheaper sectors. The bottom line is simple. We finished the week with record highs because the market believes the Fed will ride to the rescue. But if those inflation reports change the script, this crazy party could end fast. Make sure you like this video, subscribe to the channel, and hit that bell so you don't miss the next time the market completely ignores political reality. Thanks for tuning in.